What is the FM's 6-year vision? What are the reforms proposed by this government in its third avatar, in its third tenure, as also, of course, decode the income tax as well as indirect tax proposals, a lot of customs fine print, some retrospective amendments to overcome Supreme Court judgments on the GST side. But no, that's not the headline. 45 minutes into this budget, I almost thought that one of the managing editors of a business news channel, a very dear friend of mine, would be right. When I spoke to him this morning, he said, it's a battle between the heart and the head. The heart tells me it will be a great budget. The head tells me you're a fool if you believe that. So today, I think finally the heart has won, but it won in a very climatic manner. For the first 45, 50 minutes, I think everyone had their heart in their mouth, thinking, is this really the budget we were waking up to? We wanted to wake up to? The answer was a clear no. But at that time, a lot of us felt, no, you never know. Maybe there is an MS Dhoni, in our finance minister, and that would wake up. There is a Lagan, not the tax Lagan, but the last wall 6 that Dhoni and Lagan is famous for. And that's exactly what the finance minister did. Till that last 4 to 5 minutes of the speech, we really were wondering what we were up to. But the finance minister stole the thunder. That's how it was designed to be, and made some big bank announcements on the personal tax side. That is the headline. If you've been watching for the last 2 to 3 hours, any business news channel, any general news channel, there is only one thing on air, which is these big bank personal tax cuts. We had a hint from the Prime Minister himself. This morning in a tweet, the Prime Minister said that Goddess Lakshmi is going to come and bless the poor and the middle class. And what a blessing it is. There is an old saying in Hindi. They say, "Jab Bhagwan deta hai, to chappar faad ke deta hai." And in Lagan, the whole dialogue was Dugna Lagan. Here, in lot of the cases, it will be Adha Lagan, half the tax. Not literally, but definitely, as the Prime Minister said, for those whose incomes have been stagnant in the last few years, this is a tax relief which will go a long way in putting money into the hands of the people. We usually, say that the fine print, the devil is in the fine print, and over the last 3 hours, we've been looking for that. And we have experts today. Umesh by Ranjeet will take us to the income tax and indirect tax proposals in a while. But I think we all are going to struggle to find some devil in this fine print, and that old adage may actually get disproven for a change today. Over the next 75 to 90 minutes, we'll see some brilliant presentations to decode the key highlights of Union Budget 25-26. A quick hygiene note: any questions, please post them in the Q&A box, and we'll try to take as many as them in the last 10 to 15 minutes. For now, I hand it over to our keynote speaker, Mr. Dinesh Kanabar, founder and CEO of Dhruva Advisors, one of the most renowned tax experts, a tax stalwart, and whom I constantly refer to as possibly a celebrity superstar, the Shah Rukh Khan of the tax world, a man who never ages, a man for all ages. And I do remember interviewing him for the first time 21 years ago, Union Budget 2024. It was 21 years down the line. We all still want to hear Dinesh Bhai on budget day. Over to him for his preliminary comments, followed by Mr. Umesh, Gala, senior partner, who will be decoding direct tax proposals, and then Ranjeet Mahtani on the indirect tax side. Dinesh Bhai, over to you.
Thank you, Arun, and thank you for those generous words as always. But the day today actually belonged to the finance minister, as you rightly mentioned. We had, this is one of those rare times when I had spoken to several people within the ministry who are asking that what is it that we need to do for the small and the medium taxpayers. And while everybody expected that the threshold limit will go up, rates will go down, all of that, nobody expected the magnitude of what has actually happened. So yes, there was an expectation. As always, the government is known to do incremental things, and the expectation was that there will be an incremental increase in the threshold limit, the marginal reduction in the rates of tax, but nobody expected for there to be such a radical increase in the threshold limit. A very, very welcome thing. There is a statistics floating out there, and I really don't know how authentic it is, that we have 7,50,000 taxpayers totally, individually, of which 6,50,000 taxpayers are less than rupees 12 lakhs returned income. And they will become therefore zero taxpayers. They'll of course have to file a return, claim a rebate. But if out of 7.5 lakh taxpayers, sorry, I stand corrected. 7.5 crore taxpayers, 6.5 crore will go out of the or become zero taxpayers. That is saying a lot. That is saying a lot. If you can go to the first slide, and a number of transformative reforms. First and foremost, the finance minister announced that tax is one of the 6 key domains where she wants to undertake transformation. And a new income tax bill is proposed to be introduced in the parliament next week. I heard the finance minister just about a half an hour ago say that this bill, of course, will be referred to the Parliamentary Committee on Finance and will be debated, deliberated. And one will have to see what it unveils. I also heard her say that the journey to simplify the entire Income Tax Act is still going to take a year. So maybe the finance bill which will be presented may not be an end itself, but will be a series of changes which will come out there. We saw a lot of changes in reducing compliance burden, rationalization of TDS and TCS provisions. That said, if there was one area where I was a little bit disappointed, is that the changes here were tinkering, unlike the increase in threshold limit, the rationalization of TDS and TCS was not complete. Yes, indeed, the remittances limit went up from 7 lakhs to 10 lakhs and all of that, but really, that's not really what people were hoping for. Similarly, the expectation that for TDS there will be just 3 rates has not come about. A number of announcements on the indirect tax side on duty inversion, etc., to promote domestic manufacturing, and we'll talk about it as we go along. On the FDI side, insurance sector FDI increased from 74 to 100%. But on the stock market, the insurance company shares took a beating, primarily because the increase in the threshold limit is going to benefit only those who opt for the new tax regime. And which is what, of course, I totally approve of. Government is wanting to push people to the new tax limit. And therefore, people who will want to avail of insurance as a tax advantage will not be there. And therefore, the general perception was that people who will go in for insurance will go down, which, of course, I don't believe. I think people should take insurance for the right reasons and not because it offers a tax issue. A high-level committee is being set up for regulatory reforms, and that committee is expected to give report in a year. One will await to see what comes out of it and what changes will come about. And there was an announcement to say that speedy approval of mergers will be permitted, which I think is very much necessary. NCLT, as we all know, is overburdened with work. Even a simple approval, unless it is a fast-track approval, takes anywhere between 6 to 8 months, and it's important that we declutter NCLT from this routine mergers. One important change which I saw this year, which was very, very welcome, is that most of the changes which came about were for 5 years at a time. So, for example, if sunset provisions in IFSC were being sort of pushed back, they were pushed back right up to 2030. If startups were given an increased tax-free regime, it's for the next 5 years. If there are changes in charity, they are again for a period of 5 years. So it's good really that instead of talking year to year, the government gives a definitive guidance. Of course, 2 key misses. One was that there was a huge expectation and a request that we have a lower rate of tax for new manufacturing companies. For whatever reason, that has not been found favor with the government, has remained just a request which has not seen the light of the day. And second was that there was some expectation that in the field of research and development, some incentives will be announced, but nothing has happened on that side. Save and except, of course, in respect of nuclear power generation, where a sum has been set aside for setting up of small reactors. So with this overall background, I would say it's a very, very welcome finance bill. we'll have to see what comes a week later. I'm very sure that Arun will be raring to do yet another webinar to talk about the provisions of the finance bill. But while we wait for that a week later, I will hand over the proceedings now to my partner Umesh Gala, who will take us through the provisions of the direct taxes, the changes in the direct tax provisions, and then we go over to Ranjeet Mahtani to take us through the changes in the indirect taxes. Over to you, Umesh.
Thank you, Arun, and thank you, Dinesh. Before we plunge into discussion on the provisions relating to direct tax, maybe just one important point. We had the PM say that Goddess Lakshmi will bless the middle class, and today we had the FM come in as Goddess Lakshmi, and she's really blessed the middle class in a big way. I think far beyond what most people expected. And I think generally there has been a feeling that the businesses have got benefit, the lower income people have got benefit, the middle class was left out. But this time it's a big relief, and this is fortunately because I think the last few years the personal income tax have seen a lot of buoyancy, and I think that possibly gave the confidence to the finance minister in giving a bounty for the middle class. Uh, just one point on the misses, and as Dinesh mentioned that in a week's time we are expecting the new income tax bill. Of course, it will go through its own challenges. But one of the misses which comes to our mind is that currently dispute resolution is a Achilles heel for tax assessees and tax advisors. And we did not see anything major. Hopefully, in the new income tax bill, we will have uh, more specific and more robust provisions for reducing litigation.
Umesh, if I could just come in, yes, I agree with you. We are hoping that there is something on dispute resolution. But again, there is a little bit of a confusion as to whether the new bill is only going to be simplification or it is really going to make new changes itself. And from my interactions with people in the finance ministry, there doesn't seem to be a clear-cut answer out there. But I totally agree with you that there's one area where there was an urgent need to do something where we can't have 6 years waiting period for a matter to be heard by Commissioner of Appeals and the like.
Yeah. Thank you, Dinesh. As far as personal tax is concerned, again, the government has clearly moved to a path where they want more and more assessees to opt for the new regime. And therefore, what we have seen over the last few years is that the old regime and the tax slabs under the old regime, they have by and large been kept the same. The government has periodically revised and made the new regime more beneficial. This time, the relief, as we discussed a few minutes ago, the relief has been sizable. In the chart before you, earlier, I mean, there was a slabs from 5 to 30%, which was applicable for income up to 15 lakhs, which has now been extended right up to 24 lakh. And therefore, only income about 24 lakh attracts 30% tax. The total benefit, and because what the government has provided is that while these slabs are applicable, there is a rebate which is provided in section 87A. So for incomes up to 12 lakhs, and if the SSC is a salaried employee, then a standard deduction of 75,000, which will mean that up to 12 lakhs 75,000, there is nil tax, and this will be provided in the form of a rebate under 87A. During this year, we've seen the CPC create some errors, and people have faced difficulties in getting the rebate under 87A. Hopefully, by the time the provisions become applicable for the next financial year, one expects that these provisions for CPC will be rationalized. Net, what is the benefit that the sizable 1,10,000 relief for anybody who's earning income up to 24 lakh, which is sizable. Since usually we would have started with business provisions first, but because in this year's budget, I think the benefit is largely to individuals, and as we will see, not too many provisions impacting business organizations, and therefore the flow is to cover individual taxation provisions first. A small change, which is a welcome change, that currently to self-occupied properties, if a person is not able to occupy because of employment or because of business reasons, then they are considered the deemed LOP, deemed let out annual income is considered to be nil. Now they have removed the conditions and made, for whatever reasons, if you cannot occupy a self-occupied property up to 2 properties, then this will be treated as nil. It's a welcome benefit. There is a small benefit for specified employees where were covered for perquisite valuation where the salary was 50,000. This limit was kept 20-30 years ago, and government rightly has said that now they will prescribe a limit. Again, a small clarificatory amendment for NSS, which was withdrawn somewhere in 92. And therefore, they have said that, on withdrawal of amounts from NSS, it will be treated as exempt. Last year, the government introduced a national pension scheme for minors, which was called NPS Vatsalya. The deduction of 50,000 is allowable to a parent in case the parent contributes in an NPS scheme for a minor. A few clarificatory provisions or beneficial provisions have been introduced to say that, if there is a withdrawal of the money on account of death of the minor, then it will be tax-free. Of course, when the minor becomes 18, this will get migrated to an NPS of the minor. Major reliefs are also seen in the IFSC regime, and I think the government seems to be banking hugely for IFSC units in the gift city. And if we see, as Dinesh very rightly mentioned, that for IFSC, there are conditions attached to commencement of operations. The conditions for commencement of operations, which was till 31st of March 2025, now has been pushed till 31st of March 2030, which is a 5-year, no year-to-year tinkering, but a straight clear relief of 5 years. The type of units in the IFSC which will benefit out of this is if there is an investment division of a offshore banking unit, if IFSC unit have royalty or interest on aircraft leasing, and ship leasing, which is a welcome change which has been added in this year's finance bill, which we will shortly see in a few minutes. Similarly, for gains on transfer of an aircraft or a ship as part of a ship leasing business by the IFSC unit, the requirement of commencement of manufacturing of the operations is extended for a 5-year period. If there is a non-resident who derives income from offshore derivative instrument, if the transaction is now entered with FPI, foreign portfolio investor, which was earlier restricted to only offshore banking units. So now, if a non-resident has an offshore derivative instrument through an FPI, then the benefit of tax exemption is available. The government believes that IFSC is a welcome jurisdiction for aircraft leasing, and what was a provision which was for aircraft leasing has now been extended to ship leasing business. So this provision kicks in from 1st April 2026, and the sunset date, as we've discussed, has been extended till 2030. Going further on the IFSC, again, there is a exemption for dividend received in respect of an IFSC unit. This is extended. Earlier, it was for aircraft leasing. Now, ship leasing business is also included. Government has been, over the last few years, trying to encourage a lot of offshore funds to relocate from Singapore and other jurisdictions into the IFSC. And therefore, there is an exemption provided for relocation of such funds when they relocate to IFSC. This exemption for relocation has been now included for retail schemes and for exchange traded funds. A small provision, which is again a welcome provision for entities which want to create a global treasury center. A lot of companies want to create a global treasury center. Again, a welcome provision introduced where global treasury center is being located in the IFSC, provided the parent is listed on a stock exchange outside India. So if you have a company which is listed on a stock exchange outside India, it wants to create a global treasury center, then such companies will be encouraged to set up their treasury center in an IFSC, and they'll enjoy the tax exemption. A small provision which is with regard to life insurance policies, I think we could possibly move forward. If time permitting, we will deal with this. Coming to some other reliefs which are specific to the financial sector, lot of the AIFs, alternate investment funds, which were registered as Category 1, Category 2 funds. Okay, because most of these AIFs could have activity where there is a large churn. That means that they'll keep on buying various types of investments, and the churn could be higher. As advisors, we were always caveating that if you are carrying on activity which is akin to a business and where the churn is very high, there was a caveat that this could be regarded as business income, and therefore the benefit of pass-through may not be available. The government has provided a clarificatory amendment to say that if the securities are held by a Cat 1 or a Cat 2 AIF, then these will be considered as a capital asset. Another welcome provision which is introduced for sovereign wealth and pension funds, government wants to create a window of opportunity for some of the international sovereign wealth funds and pension funds to invest in the development that's happening in India. So the cutoff date earlier was 31st of March 2025. That cutoff date has now been extended for 5 years till 31st of March 2030. And 2-3 years back, we had an amendment in Section 50AA where market-linked debentures and specified mutual funds were treated as short-term capital gains. There was also a provision for unlisted debt to be treated as short-term capital gains. For sovereign funds and pension funds, if they have invested in an unlisted debt, then their long-term capital gains, if the period of holding satisfies the conditions of a long-term capital gain, they will get protected, and such gains derived by a sovereign wealth fund will not be treated as short-term capital gains. Again, a welcome provision which is beneficial for the sovereign wealth funds. Another provision which is for FPIs, there was, so last year we saw that government has rationalized the capital gains tax rate. The non-residents were liable for capital gains at 10%. The residents were liable for capital gains at a higher rate. All of these rates were collapsed to a uniform rate of 12.5%. Some of the misses that were there when the rates were rationalized to 12.5% has now been set right in the finance bill. So gains arising to a FPI on unlisted shares and a listed debenture, which till March 25 is taxable at 10%, has now been uniformly taxed at 12.5%. So this is a prospective change which will be applicable for gains by FPIs from the next financial year. Similarly, for business trusts, which have invested in listed equity shares or equity-oriented mutual fund, now they will be taxed at 12.5%. Again, nothing major, but this is part of simplification of the capital gains tax regime. On the business profits, again, this finance bill, we see that by and large there has not been much tinkering on the tax regime for business profits. Only a few changes, and we will quickly deal with the changes that have been there. So as far as the tax rates applicable to a partnership firm or an LLP or a corporate, no change whatsoever. So the tax rates for a partnership LLP continue where they were. For corporates, we have multiple schemes that are applicable. All of those multiple schemes remain as it is, no changes. A welcome change that has been introduced is a new regime, and the government has introduced a new regime for non-residents who are providing services for electronic manufacturing facilities. And this is to encourage smoothing of manufacturing facilities for Indian manufacturing entities. All of these non-residents who are providing these services, they will have the benefit of a presumptive tax under Section 44, provided they are providing services to a resident company, and the resident company will need to fulfill some prescribed conditions. Those conditions have not yet been notified, where they will get notified in due course. What is provision that irrespective of any limit? So most of the presumptive tax schemes that we usually see, there is a limit in terms of whatever is the gross receipts or turnover. Here there is no limit. Whatever is the gross receipt, that gross receipt will be taxable as income at a presumptive rate of 25%, and no set off of unabsorbed depreciation or brought forward losses against such presumptive income. Again, something which is similarly applicable for other assessees who are liable for presumptive tax. A small miss here is, and this could create some difficulty, the presumptive tax regime presumes that if you have gross receipts of 10 crores, then 25% becomes your deemed taxable income, because that's the threshold which has been provided. In case some assessee has an income lower than 25%, whether he has a choice to opt for the lower regime, the answer seems to be no. And this is an area where we could potentially see some litigation. Moving further, there is a tonnage tax regime, which is applicable for non-residents in respect of movement of livestock, goods, and materials in international. So if the non-resident shipping company operates a ship between a port in India to any international location, then there was a simplified tonnage tax regime. Again, this is not time to go into the details, but what is the provision which has now been introduced is that this tonnage tax regime has been offered to all companies who are operating inland vessels. This benefit of inland vessels, companies which are operating inland vessels, will be applicable both to non-residents as also to residents. Startups, every budget, the government believes that startups are the manufacturing boost, or boost for India to catapult to a Viksit Bharat. And there is a regime in Section 80 IEAC subject to a lot of conditions. None of those conditions have been touched, but the period for availing the benefit for startup has been extended to 31st March 2030. Standard 5-year extension, very welcome change. A small benefit, which is again a good provision, is that if a non-resident has some activity in India, which is purchase of goods for export, There is a exemption provided that, if the non-resident has some activity for purchase of goods for export, this will not be treated as a business connection in India. A few years back, they have introduced provisions for SAP, uh, significant economic presence. And there was a little doubt whether these activities could be liable to tax because of the SAP regime. A clarificatory amendment has been proposed whereby it is now clarified that if the non-resident's activity is confined to purchase of goods for the export, then the SCP provisions also will not apply. We said that not major tinkering in the regime for taxation of business profits, but there is one major change which could impact a lot of corporate mergers. Currently, there is a regime under Section 72A, which covers amalgamation of companies, amalgamation of banking units. It covers demergers. It covers uh, conversion or succession of a proprietary firm into a company or a partnership firm into a company. Similarly, there is also a regime where a company, if it is getting converted into a limited liability partnership. Now, barring demerger, where there was a very clear provision that in case of a demerger, uh, if the demerged company had some carry forward losses or unabsorbed depreciation, uh, when the demerger is in accordance with the provisions of 72A, then the unabsorbed depreciation and carried forward business loss will migrate to the resulting company. But for demerger, whatever was the period for which the losses were carried forward, the 8-year threshold would have applied basis the loss which was incurred in the predecessor entity. As far as amalgamation, conversion of a partnership or a proprietary firm into a company, and conversion of a company into LLP. Basis the current provision, there was a loophole. I wouldn't say it's a loophole. It was a specific provision. We have a few decisions also which said that if there is an amalgamation in accordance with 72A, then whatever are the business losses of the predecessor entity, they get a fresh lease of life. And possibly this fresh lease of life is something which has impacted the mind of revenue, and therefore we now have a clarification that you will not get a fresh lease of life. This provision becomes applicable from succession effected after April 1, 2025. If we look at the fine print, there could be a potential area for consideration because the wording used are succession effected after 1st of April 2025. Whether this would mean most of the amalgamation schemes have appointed date reference, and when the NCLT passes the order and that order gets filed, then it is treated as the effective date. And therefore, there could be a little bit of worry, some raising of eyebrows in the minds of the companies and tax advisors, whether if I have a pending scheme and if that pending scheme of merger, if the amalgamation NCLT order comes after April 1, 2025, whether the benefit of fresh lease of life will be available or not available. Maybe this is an area where we could take a question in the question answer session, but very quickly, at least the first cut reading seems to be that the language of 72A subsection 1, which is the section which provides benefit for the case of amalgamation, that language remains the same. So far, we have always taken the view that when the amalgamation is effected means for tax purposes, you have a Supreme Court decision in the case of Marshall and Sons, which provides very clearly that for tax purposes, the amalgamation takes effect from the appointed date. And therefore, one would like to believe, subject again for a detailed analysis, to take a view that if the appointed date is prior to 1st of April 2025, then the benefit of a fresh lease of life for such amalgamations could continue. And therefore, we could see that, all of those SSCs who are sitting on the borderline, they might, if this view is correct and if this view gets clarified, then people will try and rush with schemes with an appointed date prior to April 1, 2025. Similar provision has also been introduced for banking companies and banking institutions. Government a few years back has provided for a regime of updated returns. This regime for updated returns is available both to individuals as also other tax assessees. And what we are seeing that, the way the tracking of all transactions, especially with regard to individual assessees, transactions of credit card, because there is a wider footprint in terms of how people are spending money on credit cards, on the UPI payments, transactions of purchase of car or any other conspicuous expenditure. The government is tracking all of these transactions and basis whatever is the data analytics of the government. A lot of SSCs were issued notices, and pursuant to the notices that were issued, a lot of SSCs have updated their returns, and if there was a miss in terms of what was the return filed, then people have tried to rectify, possibly because of a nudge from the government. Given the strong number of cases where people had availed the benefit of updated return, the government has now extended. Earlier, the window was you could update your tax returns for a period of 2 years. Now, that window of 2 years has been extended to 4 years. Again, because so in case you file an updated return in the 3rd year or 4th year, you have to pay a higher rate of tax. In a situation where there is a reassessment proceedings that has been initiated against the SSC, if the reassessment proceedings is up to a period of 3 years, again, the government wants to give the benefit to the SSC that, if, despite a reassessment notice, if you want to update your return, then if the reassessment notice is within the period of 36 months, you could still avail the benefit of an updated return. Where the reassessment notice is beyond the 36-month period, if at the time of issue of the notice under 148A and pursuant to the proceedings under 148A, if the proceedings are dropped, then also the SSC will be entitled to avail the benefit of updated return. Penalties and prosecutions, again, has been an area where SSCs have been fighting with a lot of difficulty. And I think, the one provision where I would want to highlight significantly is that, under the current regime, the time limit for passing or initiating the penalty proceedings, once the CIT appeal order has been passed, even if the SSC gets into a litigation before the ITAT, there was a time window available to the assessing officer to initiate and complete the penalty proceedings. And therefore, what we would see that moment you have an unfavorable order from the CIT appeal, even if the SSC is litigating before the ITAT, he will be faced with a penalty, and therefore there is a demand. What we usually see is that moment there is a penalty which has been initiated, the assessing officer would go ahead and levy the penalty. So the welcome amendment which is now provided is that if the SSC is litigating before the ITAT, till the ITAT order is decided, the assessing officer cannot initiate the penalty provisions, and therefore you will have to only fight the tax demand. You don't have to fight the penalty which the AO was enabled to levy under the earlier provisions. There is also an immunity provisions that are applicable. So moment a penalty under 270A is initiated, there is an automatic window that the SSC has a choice to apply for immunity from penalty if whatever is the addition done by the assessing officer, if the SSC goes ahead and pays the tax, then there is an immunity from penalty proceedings. The time window which was available to the SSC for him to exercise the option for availing this immunity provision, which was earlier 1 month, has now been extended to 3 months. Again, a welcome provision. There are prosecution, and what we have seen over the last few years, that the government wants to create a little bit of fear by initiating prosecution provisions. And therefore, even if there is a default or a delay in payment of TDS, TCS, there would have been a prosecution notice. So as far as a default in TCS is concerned, if the pending TCS amount is deposited within a particular time frame, then you will not be foisted with a prosecution notice. And which time limit is, a quarter, the time limit for filing the quarterly TCS return. One would have hoped that the government could have been a little more generous by giving a little longer time window, but even this is not, this is also welcome. I think, as Dinesh mentioned that, TDS and TCS has again been a pain point for the SSC, because you have multiple sections for TDS, TCS, and the finance minister in the budget speech has very clearly announced that they want to come out with a easy compliance regime for TDS and TCS. So there was an expectation that the TDS TCS regime will be significantly simplified. The bigger expectations of the tax assessees, they have not seen the light of the day, but there are still some beneficial provisions, and we will look at some of the major provisions that are applicable as far as TDS TCS concerned. For income from a securitization trust, currently the TDS applicable is 25% or 30%. Now, irrespective of the nature of the payee, so whether the payee is an individual or an HUF, now there is a flat rate of 10% which has been provided. Few years back, we had seen TCS, which was introduced on LRS, and where the official position was that the government wants to track all remittances done under TCS, under LRS. So there was a TCS of 20%. That 20% rate was a very burdensome rate. It still continues to be a burdensome rate. Two changes that are seen. Number one change is that if there is a loan taken for education purposes for some foreign university or foreign college admission, and if the loan is availed from a specified financial institution, then there'll be no TCS on the LRS remittance for such cases. A few years back, we had seen there was a TDS or TCS applicable in case you are making payment to somebody who is a non-filer. And this was a burdensome compliance regime where SSC was making payment to a non-filer. He had to track whether somebody has filed a return and is not filed the return. And there was a onus of higher TDS or TCS applicable in case you are making a payment to a non-filer. They have removed, and I think this is a welcome change which will be appreciated by all the tax assessees, because it was really difficult to track whether somebody to whom you are making a payment has filed his return or not. There are different limits applicable, different time windows which were prescribed under the existing provision. On the TCS and on LRS, the current limit of 7 lakh has been increased to 10 lakhs. There have been significant rationalization on the TDS applicable to multiple payments, of which the one provision which is a significant relief is that if there is a TDS on rent, the current limit is annually 2.4 lakhs, which has now been increased to 6 lakhs. On the TDS and TCS, multiple sections where either, so this table very clearly explains what, where TDS TCS was applicable. The existing limits have all been increased. So 5,000 for dividend is increased to 10,000. Interest on securities, again, there is an increase in limit applicable to all such payments. We will not look at discuss each of them, but I believe that this is a welcome change. Again, at the cost of reputation, the major rationalization on the TDS TCS provisions have not seen the light of the day, and one will expect that maybe in the new tax bill that is proposed to be laid in the next week, we'll see some wholesome changes on the TDS TCS. Coming to amendments relating to assessment and search provisions, and I think there are two buckets. One is the uh, assessment and search provisions. So currently, when books of accounts are seized, there are different limits which are prescribed, where the assessing officer or the search party, within what time they can retain these books of accounts. Uh, so government and the revenue officials were finding it difficult to uh, compute the period, and therefore this has now been rationalized to say that they could retain books from the end of the quarter in which the order for assessment, reassessment, or computation is made. Crypto and virtual digital asset is a major area where government is worried, and there are a lot of assessees who are parking sometimes ill-gotten wealth in virtual digital asset. Therefore, in the search provisions, there is a definition for undisclosed income in respect of a valuable article, bullion, etc., etc. A virtual digital asset is now added to that list of assets which will be treated as undisclosed income. So if the SSE has found with any crypto or a virtual digital asset, then it will be treated as undisclosed income, and this provision kicks in from the budget day, which is today. A few provisions with regard to searches, of which again some period in case there are multiple searches, then there was the current provision where if there is a search assessment, within what time the search assessment ought to have been completed. There is a so if an assessee has been searched once and then he again gets searched subsequently, then in respect of the assessments under the prior search, they will need to be completed before the subsequent search assessments are completed. A major provision which is worth mentioning as far as search regime is concerned, that multiple assessment regimes have been, we have seen a few assessment regimes applicable for search cases. So earlier there was this old block period, then you had transitional provisions where in case of search, this was subject to a reassessment period under the Section 148 regime. Last year, the search regime was modified, and now you have a separate search regime. The major change that was introduced last year was that as far as the search regime is concerned, there were there were two regimes applicable for the disclosed income and undisclosed income. They were both collapsed into one regime. At the time when they collapsed this into a one regime, in terms of computation of the undisclosed income, there were a few gaps, and this was creating difficulty for tax assessors and advisors. So now they have rationalized and clarified how the undisclosed income applicable in a block period will be calculated. Yeah. On transfer pricing, we have seen a major change that has been introduced. The government has announced that under the current transfer pricing provisions, there is a safe harbor window which is available. This safe harbor window will be extended. We are not seeing the actual provisions where the safe harbor window will be extended, but I hope that this will be followed up subsequently. Now, a welcome provision which is worth spending a little bit of time is that if you have a reference made by the assessing officer to the transfer pricing officer. Now, most of the assessees would have similar transactions which are carried on with the associated enterprise from year to year. So this is a window which has been provided to the assessees that if you have transactions with your associated enterprise, which are multiple, and therefore if there is a assessment done for 1 year, and if you want the same methodology to be applicable for the subsequent 2-year period, therefore in a block of 3 years, you could have the same uniform transfer pricing methodology which is applied to you. Then there is an option provided to the SSC that he could opt for the subsequent 2 years. You have to make a option to the transfer pricing officer. The transfer pricing officer has to, within a period of 1 month, he has to decide whether the SSC will be eligible to exercise the option. And once the transfer pricing officer accepts the application of the SSC, then whatever is the mechanism applicable for the first year could continue for the next 2 years. And therefore, at least within a block of 3 years, you will have the same method for transfer pricing in respect of transactions for which the SSC has opted for this block of 3 years. Nothing major here. Is just that under the faceless proceedings, and there was a provision where there was a cutoff date for issuing clarifications regarding faceless scheme for DRP and appeal to the ITAD, which there was a proviso. That proviso has been deleted, and therefore the government could come out with clarifications since that time window under the proviso is now deleted. As far as ULIPs are concerned, there was some confusion with regard to taxation of ULIPs. So so there are 2 limits that are applicable for ULIPs, where the amount invested is in excess of 10%. Then these were considered to be taxable ULIPs. Also, where the amount invested for a ULIP is in excess of 250,000. These were treated as taxable ULIPs. So now for all those cases where it is a taxable ULIP, they will be treated as capital gains. A provision which is again very welcome is that all the assessees or all people who are operating in India, and if Indian taxpayers are having investments in crypto assets, then there is a regime for reporting of such financial transactions, and crypto is now included in one of the multiple transactions which will be needed to be reported, and therefore this is a welcome change. This will help the government track investments in crypto. There is a possibility and there is a fear that lot of Hawala type transactions could have been carried out through investments in crypto, where investments is made by resident SSCs, and then the cryptos are downloaded and encashed internationally. So once the reporting mechanism is now made applicable for crypto investments, possibly the government will have the provision to track all of these provisions. I think we are running a little short of time for charitable institutions. Again, very quickly, for smaller charitable institutions, there was a auto renewal which kicked in at the end of 5 years. Now that gets extended for a 10-year period. Some rationalization in respect of transactions which a charitable institution has with a specified person. And if there are some transactions beyond the arm's length price with certain specified persons who have contributed in the form of donations, the earlier limit of 50,000 increased to 1 lakh, aggregate limit, which has also been increased from 5 lakh to 10 lakhs. I think we've discussed major provisions in the finance bill applicable to direct tax. If there are questions and time permitting, then we will take up the questions once my friend Ranjeet takes over on the indirect tax provisions. Thank you.
Thank you, Umesh bhai. Good evening to everyone. We've got some amendments on the GST law and some amendments that we need to discuss on the customs law. We'll take the GST related provisions first and discuss those. Not a surprise, but the Supreme Court decision in Safari Retreats, which was pronounced in October of 2024, had a controversial aspect in interpreting the term plant or machinery, where the government actually submitted that the term is plant and machinery, while actually the text of the law said it was plant or machinery. The Supreme Court, of course, ruled in favor of the taxpayer to say that it is plant or machinery and must be read as such, and went into the interpretation of what and in what situations there would be an availability of credit in respect of construction and setting up of infrastructure. Now, the proposal in the budget is to have a retrospective amendment going back from 1st of July 2017. This, interestingly, has been proposed in a manner that it's notwithstanding any court order, decree, judgment, and effectively as if this provision was always containing the words plant and machinery in all parts of the provision. And therefore, in section 17(5), which deals with the blocking or the barring of input tax credit, it was always to be seen as not incorporating or not allowing credit in respect of plant and machinery. Now, while the Supreme Court actually sent the matter back to the Orissa High Court for a further evaluation on certain points, it also laid down some sort of guidelines and said that there are certain exceptions that come out of the provision as it was before this amendment is going to come into force, that there were two exceptions. One of those exceptions was plant or machinery. The second of those exceptions was whether the construction or the setting up was on your own account. Now, that aspect of whether it is on your own account and whether in the context of leasing arrangements there would be an availability to take credit is a question which remains open, remains unanswered, and will be agitated at the field formation level across the country. It also therefore means whether there will be notices issued for those taxpayers who have made a claim for credit in respect of it being plant or machinery, and whether there is now a sort of demand that can be proposed because of the fact that this effect of this amendment is retrospective in nature. Interesting times. We'll know as we go along whether those notices will really fructify, and we'll have a further spate of litigation on this point alone. The other proposal that has been made and is significant is the tax adjustment and reduction of the tax amount on account of credit notes that are issued by a supplier. Now, it is proposed that it will be permitted, the reduction will be permitted only if the ITC that is availed by the recipient, if ITC was availed by the recipient, is reduced. So there has to be a reduction, a corresponding effect by the recipient, whereby they reverse the credit they have taken if they have availed it. And this is in the case of registered taxpayers. This will be an interesting aspect, because it has been so far not possible for the supplier to detect, to know whether the recipient has a reverse credit, not taken credit, whatever the situation may be. But with the introduction of the invoice management system, which will soon become mandatory, all of this will be necessary, and the credit adjustment would be mm, sort of predicated on the point that you have this receiver having reversed the credit that was availed. The taxation of vouchers has been under some sort of debate for a long time now. Recently, it was settled that there is no GST to be applied on vouchers per se. Corresponding to that, the concept of time of supply of vouchers and how and when they should be taxed has been omitted from the statutory provisions, and that's just alignment and sort of hygiene issue, as I would think of it is. The other development that has been or that is proposed is more in the nature of a explanatory, or I would like to believe clarificatory amendment, where there is going to be an enabling mechanism to distribute ITC of IGST, which is paid under the reverse charge mechanism through the ISD route. So this wasn't explicit, and while the law enabled or was clear that the CGST component, the SGST component could be transferred, distributed through the ISD mechanism, it wasn't as clear for IGST, and this proposal will sort of address that open point, so to say. The GST law has certain exemption and certain sort of concession for and in respect of activities which are concerning the government bodies, local authorities. And within that is a concept of a municipality committee, and the like. Now, whether it is in the context of certain services provided or certain services received by such local authority, which includes a municipality committee, there is a term or a sort of expression which they've used in the law, which is municipal fund, local fund. But these were undefined, these were unclear as to what their scope and ambit was of these particular expressions. There has been a proposal now to make an amendment by introducing a definition in the GST law to give us a clarity on what is a municipal fund and what is a local fund. And that will just bring in a lot of certainty and clarity as we move forwards. In the in some time ago, there was a in enhancement of the Schedule 3, which concerns transactions which are neither goods nor services, whereby warehouse goods that were cleared were treated as not being a transaction of goods or services. Now, that is sought to be enhanced by introduction of another entry in that list, whereby supply of goods which are warehoused in a SEZ or in a FTWZ to any person before they are cleared for export or into the domestic tariff area will be treated not as a supply of goods or services, i.e. they will be considered as part and parcel of Schedule 3. And this amendment is retrospectively applicable from the 1st of July 2017. Simultaneously, there is also a provision that if there was any tax paid in such scenarios or in such transactions, there will not be allowed a refund for such cases or for such transactions. An aspect that sort of comes up and may be addressed in the times to come is whether any sort of credit related reversal, especially for common credits, is required or not, owing to the classification of such transactions in the Schedule 3. As we wait for the GSTAT, the tribunal, to be sort of up and running, there has been quite a bit of litigation which has begun. And at the first appellate authority, of course, we are seeing considerable action. Now, in all of the sort of appeal that we have in the GST law as well, there is a concept of pre-deposit. Now, in the present budget, the proposal is to enhance effectively the the pre-deposit that is payable in the cases where only penalty is the subject matter of the order. So in the table, we have brought out that in cases which involve only penalty, previously and as on today, there was no pre-deposit to be paid if your order was concerning only penalty. However, going forward, after the budget proposal goes into force, you will have a 10% pre-deposit amount of that penalty amount. In respect of, and on the other hand, in respect of the cases involving detention or seizure of your conveyance, which is in transit, typically in the case of e-waybill matters. There, the statutory provision actually provided for 25% of the penalty amount to be paid as a pre-deposit for an appeal to be heard or entertained. Whereas now going forward, there is a rationalization, and that will be 10%. And that's a welcome move. Because oftentimes we see penalties are imposed at the maximum possible level by the authority at the first instance, and then to have an appeal against that would mean a quarter of it having to be pre-deposited, whereas now it will only be a tenth of that. In respect of certain sensitive goods or evasion-prone commodities, track and trace mechanism involving a unique identification marking system is proposed to be introduced. And it's also proposed that if there is non-compliance in this situation, there would be a penalty which could be as high as 10% of the tax that is payable on such goods. Moving into the amendments and proposals in respect of the customs law, we'll discuss first the changes that are proposed in respect of the customs law, and then in respect of some of the rate that are proposed. The first one in the law is concerning provisional assessment. Hitherto, we had no timelines given in the statutory mechanism as to by when a provisional assessment has to be finalized. That was recognized, and today the Finance Minister has proposed that a 2 years timeline from the date of such provisional assessment is the timeline within which the finalization must take place. It is extendable by 1 year by giving justifiable reasons and by a superior authority in the hierarchy, but not in all cases would that be possible. And they've also provided for certain exceptions where this particular 2 years plus 1 year timeline would not be applicable, namely in cases where there is information sought from authorities from outside of India, typically in a case of involving a free trade agreement and a certificate of origin. The other development that has been proposed in the Customs Act is a very interesting one, and I would think of it as a trade facilitative measure, where for a post-clearance, there is now an ability for the importer or exporter to make a voluntary revision. Now, the voluntary revision would be in such a manner that the bill of entry or the shipping bill can be amended so as to pay, if need be, a further amount of duty, or if the position is that a refund has to arise because of that, there is a deemed position of the refund claim being made by virtue of such self-assessment, which is made on a voluntary basis. Now, this is a new provision. I think we are going to see some amount of interpretational aspects come around on this. There is an indirect sort of form in which a timeline has been prescribed. There may be a lot of regulations or rules as to how this particular provision is to be made effective. But overall, this gives the importer-exporter an added avenue apart from what does exist in the current law, which concerns a discretionary power in the hands of the proper officer to amend certain documents. Now, the importer or exporter need not sort of apply to the proper officer for a approval. They can go ahead, make a sort of self-assessment whereby they revise or they make a revision of the assessment that has been previously made, and thereby either pay the duty that needs to be paid over and above what was paid, or effectively then go into position of claim for refund. In some way, this possibly will also enable the process and procedure to be made far simpler when you consider it from the point that the Supreme Court in ITC's case had effectively said that each bill of entry has to be challenged and thereafter a refund claim has to be made. In this particular situation, we will have the ability to go make an amendment, effectively make a self-assessment, and by virtue of that self-assessment, a refund claim is deemed to arise, and then maybe that will take care of the extra process that was until now had to be undertaken. A development which is maybe somewhat delayed. In the context of the income tax law, it was brought in February of 2021. Now, for the customs, for the Central Excise Settlement Commission, it is effectively to be abolished, disbanded from the 1st of April 2025. An interim board for settlement will take charge and handle and take and address the cases that have been filed till date from the point of where they are, and whatever be their status, they will be taken forward to their logical end. And therefore, all the pending cases as on 31st of March will be handled by this particular board. It seems that the government, of course, has no intention or liking for this settlement mechanism, originally taken off from the income tax law and now even from the customs and central excise law. It is interesting that while the trade and industry were hoping for or requiring a amnesty scheme, the government has not introduced an amnesty scheme, but at the same time has taken away the settlement commission as a body to have a dispute resolution in these two laws. A sort of welcome move is the time limit, which has been enhanced from 6 months to 1 year for end-use condition-based imports, where previously you had only 6 months to undertake the end use. Now you have an enhanced period of another 6 months, totaling to 1 year. Sort of concomitant with that is the quarterly statement filing for such imports, which replaces the monthly requirement under the import regulations concerning such imports. On customs tariff rationalization, there have been quite a few changes and quite a few modifications that are proposed. The underlying sort of objective, of course, is to enhance manufacturing in India, make in India, to provide for employment opportunities, and to address inversion or inverted duty structures. So with that in mind, the tariff rates have been reduced from 25% to 40% in that bracket to 20%, and from 100% to 100% to 150% to 70%. But simultaneously, the Agricultural and Infrastructure Development Cess, the AIDC, has been increased in several cases, or in most cases, whereby the effective rate of duty, considering the basic duty rate and the AIDC, effectively there may not be a substantial change, but that would have to be looked at for each tariff line item and evaluated considering now the enhanced or the higher AIDC that needs to be applied on such imports. Overall, there is also the intent, or as the speech mentioned, that the social welfare surcharge will be exempted on 82 tariff line items, but there may be a cess that is brought in, and a common cess will then sort of be applied like the AIDC, or it could be the AIDC itself which will apply, and therefore effective duty rate remains the same, or more or less the same. 7 tariff rates have been removed. There's, therefore now a streamlining of the entire structure to 8 rates in effect in the Indian tariff, the customs tariff that we have. With that, we've got, covered most of the key or the prominent changes that have been proposed in the GST law and in the customs law. I'd take it to Arun now to take it up further.
Yeah, we have a 2020 to play. I'll first read out. There are some 30 questions, so you have to use the moderator's discretion. First of all, Umesh by Ranjeet, thanks for the wonderful presentation. I'm just take a few questions which I've earmarked. The first one goes for Umesh by whether the amendment to Section 72A applies prospectively. This is on the carry forward of losses. And how do we interpret the word affected? Does it mean appointed date for the merger?
Yeah, so I think this is an important question emanating from the provisions of the finance bill. As we've discussed earlier in the presentation, that the current provisions of 72A say that in the case of an amalgamation or conversion of a partnership or a proprietary concern into a company, the business carry forward business losses become the losses of the year in which the amalgamation was effected, and the word was effected. Basis the current jurisprudence, so the new provision still uses the same language of effected, and therefore one would like to believe that in respect of an amalgamation, if the appointed date is prior to April 1, 2025, then one would still be able to claim the fresh lease of life. So therefore, if there is a business loss which was 5 years ago, if the amalgamation appointed date is before April 1, 25, then you will get a 8-year window, which is, the old provisions will apply, and therefore, at least in the case of amalgamation, this provision could be considered as a possible view. In case of a conversion of a partnership and a proprietary concern, again, the word affected would mean that whenever there is a business transfer, whereby the existing business of a partnership or of a proprietary concern is transferred in the process of corporatization into a company, if this has got effected before April 1, 2025, one would believe that the fresh lease of life will be available. However, with regard to conversion of a company into a LLP, because this is a statutory framework, whenever the company gets converted into LLP, and which is when you will get the certificate of incorporation as a LLP, that would be the effective date. And therefore, in such cases, if you are not able to manage the conversion before April 1, 2025, you could lose out. I hope this is
Yeah.
suitably clarified.
Yeah. Umesh, my last 2-3 more questions quickly.
Sure.
Then I'll go to Ranjeet for a couple more. One is here. Taxpayer has been issued notice under 148A before expiry of 3 years. Can it file an updated return?
Yeah, again, a welcome change, and again a window of opportunity provided to the taxpayers that despite a notice of reassessment under 148A or 148, if it is within the 3-year window, then the taxpayer is permitted to update the return, and therefore you would be able to possibly escape with a lower tax payout as opposed to the tax liability that will be foisted on the SSC in case one doesn't opt for the updated return, and then you are not successful in defending the 148 notice.
Ranjeet, this one is for you. On ISD, corporate office will distribute credit to SEZ as well. Has government clarified any position on refund by SEZ unit?
Refund to an SEZ unit is enabled, and it has been granted in certain instances practically. But there is no clarification on the point in specific.
One more question on the same. What is the change made with respect to SEZ and GST, stating that it would not be supplied?
So when warehouse goods are in a SEZ unit or in a FTWZ unit, and they are supplied outside of the country in the export stream or into the domestic tariff area, which is effectively home consumption, the transactions that are there before that happens meaning they are cleared for export or cleared into the home territory, those transactions will not be treated as a supply of goods. Therefore, if it moves from SEZ unit to FTWZ or SEZ to export or SEZ to the domestic area, that transaction will not have a GST implication. The domestic clearance that is there, the receiver will have to effectively reverse charge the duty and the GST as it goes into the domestic territory.
One from Amit Banka. Basics custom duty BCD on IFPD has been increased from 10 to 20%. As IFPD is imported under different HSNs, please clarify on this amendment with reference to HSN.
Yeah, we'll have to look at the HSN for that, Arun, and particularly goods are classified with reference to description and HSN code, and while the proposal is for a particular HSN code where the tariff rate has been reduced, it will have to be seen that when the product has been brought in, which different products have been brought in under different codes, whether they fall within the code which is now reduced.
Umesh, this is for you. This comes from my good friend Dheeraj in Pune, and he specializes in charitable trust. This enhancement of period of 10 years from current 5 years for small trusts will be applicable for present trusts which have not yet completed their span of 5 years, or will it be applicable post the renewal? Or
Again, we'll have to look at the fine print, but basis whatever I have seen so far, even for an existing trust, if your renewal has not kicked in, that 5-year period will get extended to a 10-year window.
Yeah. There are 2 or 3 questions which are saying that you provided such big personal tax relief, a big hole in the pocket for the exchequer, upwards of possibly 1 lakh crore. How are they still projecting a tax increase of 15%? So you never know. The government has the magic wand of Harry Potter. So, but jokes apart, I think they're factoring in tax buoyancy. If say for example the consumption is more, automatically the GST collections will definitely go up, because it's an indirect tax, has a all pervasive effect. So I'm assuming that what they're factoring in is tax buoyancy, because the CBDT chairman has already raised the victory flag, saying they have crossed the finishing line and they are going to be well ahead of the 22 lakh crore net tax collection target for this fiscal.
Maybe just a minute or so, I think. Yeah, so I believe that the government clearly believes that this is a carrot and stick approach. I think the way all the transactions are being tracked, I think that is the stick, and therefore you are seeing a lot of compliance in India. Most of the compliance always is with a little bit of stick. But I think the government has clearly seen a lot of buoyancy, and I think this is the confidence. And internationally, one has seen that when the tax rates are reduced, the overall buoyancy in terms of more people opting for filing their returns and more people declaring the rightful income, that also pushes up the tax collection. So combination of both of this, plus the development that's happening in India, could see the revenue numbers projected by the government being achieved. So I remain quite optimistic.
The GST increase is projected at 11.3% for FY26. Yeah, that is quite significant if you consider the fact that there is a 1 lakh crore hole, as you said, in the pocket.
That's the perception.
Small point here. I mean, we've seen the amount of freebies that are being distributed by multiple state governments. I think we are sitting in Maharashtra, and I think the Ladki Behan has seen 46,000 crores just by one state. And therefore, I think 1 lakh for all India, for the government of India, in the backdrop of the carrot and stick and the buoyancy, seems decent.
A quick update to everyone. I was looking at a time series data this morning, and which is why my frustration possibly took over, and I said we need something big bang. But I've been saying for the last few years, not today alone. But if you look at the time series data, the income tax collections have gone up in the last 23 years from 1 lakh crore to 22 lakh crore. In the last 10 years, they have gone up from 7 lakh crore to 22 lakh crore. So that's the sort of buoyancy we are talking of income tax collection, though people may think the tax GDP ratio is less and whatnot. Yeah, but that's the that's the context. Umesh, wait, 4 to 5 questions, and I'm clubbing all of them on the 12 lakh. Where does that 12 lakh kick in? When will I get rebate? Someone here is saying that, I'll have to claim a return. If the income is below 12 lakh, one has to file a return to claim rebate. Whereas if even there is 100 rupee capital gain, I'll have to pay tax and file a return. So exactly what are these nuances of this 12 lakh? I got a call from a leading journalist as well asking that what happens if my income is, a lot of people have asked, general people, not for this audience, but what if there is 15 lakh of income? Am I taxed on the entire 15 or only 15 minus 12? So the answer there is obvious, but I think there's a lot of confusion about what happens if it is just somewhere between 12 and 13 and so on.
Yeah, so I think important provision which needs clarification is that this zero tax till 12 lakhs plus standard deduction is only in the form of a rebate, and therefore two things will happen, that you will be still required to file your tax return, and therefore the tracking that the government proposes to do will continue. And therefore, if you have income in excess of 12 lakhs, you calculate the tax as per the applicable slabs, claim the refund under section 87A, which will amount to a savings of 1,10,000.
Yeah. I think we have time for 2 questions. I know there's a hard. We have
a hard stop at 6:29. So I'll go for the last 2 questions. In case of, this is a nice one. In case of Section 72 amendment, how do we read the original predecessor entity and the first amalgamating company? What does this mean?
I've not actually followed what the question is, but
On the carry forward losses. So the words used in the amendment are that the predecessor entity is the first 8 years from the time the predecessor entity. But I don't think they have necessarily defined the predecessor entity. Maybe you think they'll define it later?
So if there are multiple amalgamations, I think you'll have to possibly look at. So if there are 2-stage amalgamation, then you'll have to look at the loss of the first entity. If that entity got merged with a second entity and that second entity got merged with a third entity, again I think this will have to be checked basis the actual provisions. But I think whatever is the window. If the loss was 4 years ago, then you get only the balance 4 years.
We are almost done. I'll take the last question. 10 seconds to Ranjeet. Safari retreat, retrospective amendment. Ranjeet, disappointed? 10 seconds.
Not at all. I think this was pretty much
Big.
expected by quite a few quarters, and not surprised.
Not at all. There are some 25 more questions. We can't take them. There's a hard stop at 6:30 today. The gentlemen have to rush for a series of more webinars. We are so happy that TaxSutra and Dhruva continue to bring to you, the first clinical analysis of the union budget year after year. The income tax bill is promised to be delivered next week. We'll get the first sneak peek when it happens. We'll be back then. For now, many thanks to the audience. We were houseful. So many joined on YouTube. Thanks for all the questions. Thanks for the participation. Stay glued to TaxSutra's unrivaled coverage of Union Budget 25-26. Thanks so much, Umesh and Ranjeet, for the
Thank you for the first day, first show.
Thank you.